This channel is for educational purposes only. Please do your own due diligence before making any investment decisions. Hi, this is Joe Rabil with Invest Like a Pro. And so today I want to discuss a specific trade setup. And I have made mention over the course of the last month or so about how if I'm going to do a swing trade in this type of environment where we have a lot more volatility and a lot more gaps, that I like to use options. And so I want to give you a specific example of how I would go about doing that. And use this trade setup in Pfizer. And what I want to do is show not only the setup and the trigger, but also how the options would have traded or traded around this play, and how I would go about entering, as well as the length of time I'd want to give the option, and then also where I would be looking to take profits. So let's go ahead and get into this example. Again, it's Pfizer. So even though the trade is a swing trade where I'm using a daily chart and an hourly chart combined, I'm really like to see what's going on in the bigger picture. And what I really like about this setup is look at the ADX on the monthly chart. You notice how this is rising. It's at 30, 30, 31. When it triggered, it was probably in the high 20s. But I just like the fact that green DI is making higher highs and higher lows, and we've got nice slope to the ADX line itself, showing there's good underlying momentum in place. And then also, when we look at the weekly chart, look at this ADX. So we had a strong move, and that was a pretty strong retracement. You pretty much retraced that whole leg to the upside all the way back. But look at how much, when you look at it from an analytical standpoint or a mathematical standpoint, this actually still shows up pretty well. Green stayed above red throughout the pullback. And then we got another leg to the upside. Now, this little pause here after breaking out is really what I'm focusing in on right here. So right in this area right there. And that would be this pullback on the daily chart. So I want to make sure I'm just looking at this. I'm looking at the volume pattern. I'm looking at the ADX. I'm looking at MACD. Based on the monthly and the weekly, I've got everything in my favor. The only thing that's kind of working against me, if there's anything, is that we're a little stretched away from the moving averages, but really not that bad for a swing trade. On a weekly chart. The monthly chart, so one thing I should mention is that if I had a signal after this kind of move, so my 18's down here and I've got a monthly like that, and I'm looking to do even a swing trade, I'm probably not interested. Right? But this is not that far. I mean, yeah, it's far from if I'm doing a bigger picture trade, but for a swing trade, I mean, we could just make a move like that, and it really could be totally fine. So with that as my backdrop, I know I've got good momentum. I like the price volume action, and now I get my pullback on the daily chart. Got rising moving averages here. Okay, I know the trend is bullish because I'm making higher highs and higher lows. I love this ADX pattern here. We get the pullback towards the moving average, and this is well above 25 during the pullback. I don't see any outlandish selling volume during this pullback. So all of that is working in my favor. If there's one negative to this whole thing so far, it would be this one big bar right here. Right? I mean, that's a pretty good size red bar. However, I know I'm not going to trigger using the daily chart. I'm going to use the hourly, and that should save me. If I'm waiting for the hourly to really get back in line with the daily chart, then that should save me from any kind of false signals or premature triggers, anything like that. One thing of note I think I should mention also here is sometimes I think people see this crossover and they kind of want to shy away. And so I think the same thing sometimes, but you also have to continue to watch this when you have strong ADX. And the reason why is that this actually turned into a reverse divergence pattern. So this is more like about a double bottom, maybe a slightly higher low, and this is clearly making a lower low. So at that point now, I'm not concerned about the MACD in this trade. I am looking to play any kind of a trigger off the hourly. So let's go to the hourly now. And we've got, so during this pullback, that's this pullback here, okay? And obviously, if you've read my book or seen any of my videos for any length of time, you know that I like to see a counter trend trade going. So I want the 18 to cross down below the 40 on the lower time frame, while these are going in the opposite direction. So I know this is the trend time frame that I'm trying to trade, and I actually want to see these going in the opposite direction. I want them 18 below the 40, and I want price below both moving averages. So now I have my setup in place. Now, in order to get this really to trigger, the first thing I'm looking for is any signs of divergence. And I don't really have that because during this decline, we had some pretty good negative DI, and we got a pretty decent reading on the red DI. So I got that, and then MACD also made a new low with price. So I'm not gonna get one of those really early signals right off the bottom. I've got to be a little bit more patient here, because I'm not seeing signs that the momentum is so weak that it's going to turn on a dime and take off. So one of the things I like to see when this takes place is for price to come into the zone between the 18 and the 40 and then come back out. And we get this with this one bar right now, right here. So price goes in, it actually gaps up on the hourly and then gives it up. I love to see that because I want to see a test of these lows, this first leg down. And if you notice what happens, it doesn't actually take that out, it goes sideways. Now, this would have been a pretty aggressive entry, I think, because we have this big red bar here. But it is something you could consider. Now, I probably would not be taking that trigger in an option trade because I don't want to get stuck in something that lasts a long time. I'd rather see it get back through the moving averages. So really, this would have been your earliest entry, and that is essentially a pinch play where the MACD line is crossing back above the zero line. But I think for argument's sake, in this pattern, because it was so slight, these bars were not big and it wasn't all that powerful, let's just assume you waited for this. And I'm sure you feel like you missed the good entry by waiting for it to gap up or whatever. But I want to show you something because this has happened to me a number of times when I do the options. So if you waited for this bar and even waited for the close of that bar here, you pay about 36 cents for the options. Now, the options that I wanted to use in this case, it was the 13th of December. I gave it till December 31st. So I did the December 31st options. I'm paying 36 cents, and these are the 60s up here. So I'm buying call options. They're the 60s, and I'm giving them about 2 weeks, a little bit more than 2 weeks in this circumstance. Now, that might seem like not a lot of time, but just realize if I'm getting a trigger like this, it should move in my favor right away. And if it doesn't, then there's probably something wrong with this setup. It might not work. And so I don't think time is the issue. Actually, the strike price is more important in a lot of ways for these trades. I wanted to use 60. It was pretty aggressive, but I felt like if this trend is strong and we've got a reverse divergence here, we could get a slingshot. It won't be as big as this leg, but somewhere when you look at it, it just made sense to look at the high 50s as a target area. So if high 50s are my target, I can use 60 as a level. And I know that even if I don't make it all the way to my target, not my target, but my strike price, the value of these are going to go up if it happens pretty quickly. So we get this move and then it pauses for a couple days. So, these are sitting around 35 cents when you buy them, and then actually probably dropped a little bit. But then once this got going in the next, so there was a pause day after the entry, and then we had two big up bars. When we reached a peak in price up here, the options actually got up to 280, 290, something like that. And I'm not suggesting that's what you get here. What I would actually do if I have if I'm paying 35 cents for the options, I know 70 cents, I basically double, right? If I like to do the triple. So I'd be looking for something like $1.35 times 3. And that would be 70, 135 plus my entry. So somewhere around 150 to 175 would be my target area. I'm not trying to be a pig here. I'm not trying to make it all the way, but I'm saying if I can risk 35 cents and make $1.35 on that trade, then that's a great trade. That's 3 times what I risked. And that's how I would go about doing it. So I would have no problem having an order waiting up there. Now, what you have to do with an option, and I've mentioned this, is you have to be willing to watch. You're going to have to watch it bar by bar, because if, let's say we get a bar that goes up and then it closes in the middle of the bar or something like that, and it looks like there's sellers, and let's say there's pretty good volume on that, you might just have to take what the market offered you. And say, let's say that's this bar right here. And instead of closing really strong like that, it actually gives it back halfway, gives up half the gain for the day. And your profit, which might have been, let's say, I don't know, maybe it was like 70 or 80 cents, comes back to like 40 cents or 45 cents or something like that. You just have to accept, okay, this is all I get for this trade. It's a small win. In this case, it actually closed really well. You could have waited to see if your target got hit, and it would have been hit the next day. So this is how I think I would go about doing this. Now, you have other options with, or I should say, choices when it comes to managing the position. Like if you put up 35 cents. Oh, one thing else I should mention here. So I'm saying 35 cents, and what I do is I decide how much I would do if I were going to invest in the stock. So if I were going to put up $250 in the stock, and that is to my risk to my stop level, then I'd figure out how many shares I would do. And then I would buy that many shares, and that would be my risk to my stop. But in an option, I figure out how much that, so let's say it's 250, and just to keep it simple, let's say it was 350, and I know I'm paying 35 cents, so I'd be able to do 10 of the options. So I'm risking the same amount in the options that I would be if I were investing in the stock. Now, the reason why this is an advantage is that if we come in one day and there's a big gap, or let's say there's negative news on Pfizer related to the COVID, and this just has a monster gap down. Well, you're not going to get your stop in the price level. Like maybe you were risking 50 cents in the stop. You're probably going to lose $1.50 in the stop, hitting your stop by the time you get stopped out on the opening gap in your stock trade. But in your option, you're still going to lose 35 cents. It's not going to change. You're going to only lose what you put up. So that's the big benefit to doing these. The other thing that I think is a big benefit is that you don't have to, if you have let's say you put on a trade and there's a little bit of a wiggle against you at the beginning of the trade, like let's say it comes down and it takes out this prior low that you might have used as a stop for the stock. But you don't get taken out there, and then we get a move to the upside. I've noticed that when I put up the amount of money that I'm willing to risk, and I just let go of the trade, I usually have a lot more patience for an option trade because I know I don't have that downside gap adverse risk against me. So this is how I think is a good strategy during periods when volatility is high. I've been talking about how the volatility is high. I could have done a short trade, same thing, using the puts. But if I'm going to do a short-term trade using like a swing trading method, this is how I'm going to go about doing it. I like options that cost somewhere between 35 cents and 70 cents. I don't really want to pay $1.50, $2 for my options. I'd rather get ones that are at undervalued, what I would conceive to be undervalued. And if we get a move in my favor, a move from 50 to $1 in the options can happen really quickly once the size of the bars start to expand. So anyway, that is a strategy, I think, for using options on a swing trade. Let me know if you have any questions or comments, and we'll see you next time.